Good morning. I'm Afsaneh Beschloss, CEO of the RockCreek Group, and I thank you for joining us this morning to talk about global markets. We're very, very fortunate this morning to have Dr. Alan Greenspan with us and Liaquat Ahamed. Most of you have heard both Dr. Greenspan and Dr. Ahamed on our previous calls, so they don't need much of an introduction. But as you well know, Dr. Greenspan, who is best known for having been Federal Reserve Chair for 19 and a half years. Did I get that right? You'd also have to, if you haven't already gone to the bookstores and bought Capitalism in America, you have to order it on Amazon or go to the bookstore and get it. It's an epic book that traces the evolution of innovation and entrepreneurship in America, and we'll also touch on the book at the end of our call today with Dr. Greenspan. We're also fortunate to have Dr. Ahamed with us. Liaquat spent about 25 years as an investment manager, but he is most sought after by many Fed chairmen and central bankers all over the world. And of course, we know him also for his book, Lords of Finance, the Bankers Who Broke the World, that won a great Pulitzer Prize for history. Since our last call, a lot has happened. We had much happen in the markets. The VIX hit a big high after many, many years. Last year, towards the end of the year, we had the markets have one of their most volatile periods in December of 2018. And we are seeing a major economic slowdown. It's almost like we went from supposed synchronized growth to synchronized slowdown all over the world. So a lot of interesting topics to touch upon. In terms of what happened at the end during 18, but particularly those last moments as we had that huge whiplash in the market, I was curious to know what surprised you both. Dr. Greenspan, do you want to go first?
I thought it came as a surprise. We have a very unusual government, and the usual means by which we evaluate it historically don't apply in this context. So the markets are trying to figure out what the President of the United States is thinking before he does. Or neither one of them seem to get it right.
That is very true. Liaquat?
I would put emphasis on the Fed. Towards the end of last year, they were unusually hawkish in suggesting they were going to raise rates by another 75 basis points in 2019. And then they turned on a dime and left us with the expectation currently that there will be no rate hikes next year. And that 75 basis points change in expectations, I think, explains why the market went down so much in December and why it's come back up so much in January.
We'll get to the rates discussion in a second, but is your sense, sort of, as we go into 2019, that that GDP growth rate, everyone's talking about this 2% growth rate, is that realistic, or is it going to be more like 1.5% or something even worse?
You know, I see no evidence of a substantial slowdown. I mean, there is some evidence of a slowdown, particularly in the softer sort of expectation data, but the actual numbers don't suggest there is a slowdown from, you know, the high twos to the mid twos. We're just talking about the US.
Absolutely.
I think the biggest change in expectations about growth has been outside the US. In China, the substantial slowdown in Europe, and maybe that explains why the Fed changed so much. I think a bigger explanation is the Fed was quite spooked by the market. And it's got itself a little, it's somewhat at sea because it doesn't seem to have a discernible compass guiding policy.
Alan.
Am I being too harsh?
No, I'm in a very odd position. Paul Volcker, for 18 and a half years, was never made any comments about Fed policy of his successor. And I thought that was extraordinarily helpful to me, because there's nothing like having your predecessor second guess you. And as a consequence, although I'd love to get into this particular conversation, I have made a vow that I will not.
Well, we will still try, but but going back to what Liaquat said, I'm curious about that. I mean, I thought that that Chairman Powell has actually done a great job, and one of the things that has been really interesting about that last month of last year was that as we were contemplating maybe a quarter point increase or not, we're in an environment that historically has been very low rates. So is it because a lot of people who are hedge fund managers and managing money basically been doing it for the last 10 years, so they grew up in a period of zero interest rates, and psychologically 2% is a high rate, because 2% is really, again, looking at it historically, is not something that significant. So going from 2 to, exactly, and a quarter point increase to where we are today, typically, if we look historically, maybe should not have been such a big deal. So I'm a little curious, and I don't know if you can comment both historically.
Well, I can comment on the interest rate issue. Let's remember what interest rates are. They are a function, they are derived from human time preference, that there is a certain way human beings, for as far back in the past as we can get, valued time in a certain sense. So that if you go back to 5th century BC Greece, interest rates are where they are today. And that suggests to you, if you go through time, interest rates go up and down, but there's a human time preference issue here, which essentially locks in where the rates go. I, as a consequence, like not to look at the federal funds rate, which I've seen for a while. I look at the 10-year Treasury note as indicating what's going on, but the presumption that there are these changes that are going on of a fundamental nature, I think are just mistaken.
So two things. One is on the Fed funds rate. It's not what the Fed did, it's the expectations they generate about where the Fed funds rate will be in the future. So by middle of December, Chairman Powell gave us the impression that the Fed funds rate was going to go up to 2 3/4 to 3% by the end of 2019. He's now left us with the impression that it's going to be 2 1/4%. So it's not the 25 basis points change.
It's the four increases.
Yeah, it's the expectations. Now, the question is, was that change in policy justified? Now, I think there were three things that happened. One is inflationary expectations, which had been rising, stopped rising and started falling. And we all expected some increase in inflation, and that has not emerged. And that's a very positive. And you see that in the 10-year note, which went up to, I think, 3.3 and is currently at 2.7.
Or look at the 30-year Treasury coupon, which I find even more interesting and useful as judging where the markets are than the 10-year note. That extra 20 years of what is being discounted in the future, I think tells us a great deal which we don't use sufficiently in our analytical work. The economy is based very heavily on capital investment, and that capital investment is a function of what markets presume will be the rate of return almost indefinitely into the future. I mean, you can sell a 100-year bond today. You always could.
Right.
And the question is, well, why is it? Why do people...
Even Argentina could, just a little while back. Sorry.
No, but it's very interesting. Markets accept extraordinary things in the interest rate capability, and the only thing they really ask about is the person risky or not. Not that risk fundamentally as a human propensity will change. That's a given. It doesn't.
You were going to also talk about your views on the rates.
So inflationary expectations stopped going up. Growth expectations were revised down modestly, but they were really revised down outside the U.S. And I think that's the fascinating thing, that we seem to be getting a global, a coordinated global recovery.
A synchronized
exactly.
slowdown, yeah.
And now we've got a slowdown.
Yeah.
And it's driven, as far as I can tell, largely by China. Even the slowdown in Europe can be attributed to the fall in Chinese demand for German exports and European exports. And the question of where China goes is, I think, the central question in figuring out sort of investment strategy over the next year.
That's really interesting because Alan talks about China often and the US, and he has a long history in China. So looking at China and the US, Alan, it generally has been the US economy that has been the dominant economy and sort of calling for what happens in the rest of the world. Do you see a major shift in power between China and US?
No, but I see a major shift in power in China, which of course will come out to be the same way. As you know, I dealt fairly heavily with the Chinese government because of my Fed relationships from 1990 forward. And I got to know all the leaders. Zhu Rongji, who was premier and had previously been central bank, People's Bank of China governor, Zhu Rongji and his boss, President Jiang Zemin, dominated the 1990s, and I got to know both of them very well, and their central focus was, how does China become a market economy like the United States? And I'm looking back in history, you go from Mao Zedong, basically frozen system, and then Deng Xiaoping came on, and he made a few little changes, and the economy exploded. And that caused China, working off Deng, to come up very dramatically until, I would say, probably a year or 2 years ago. And to me, the sign that something had changed, because every single 10-year tranche, which is what they were doing, became more and more liberal. So when we got into the 1990s, I'm sitting there discussing China policy with the key Chinese policymakers about how does one appropriately get interest rates characterized for foreign deposits in our banks. And I'm sitting there and I'm saying, what has happened to the world? Well, if you trace it all through each of the various different 10-year periods, did show very significant change. And I knew something was afoot when I've forgotten the names now of who came after Zhu Rongji and his boss, essentially. And they were really quite mediocre, they showed none of the characteristic of going back in history. Something happened in the Politburo when the discussion began to emerge as to who would replace Jiang Zemin. And so we got mediocre people, and then we got a very startling thing, which should not have come as a surprise, that the 10-year span came to an end. And Xi, as President Xi, is there indefinitely. That is not an accident. I think it happened 10 years earlier. Something about the power within the Politburo. And as intimate as I got with Zhu Ranji, I purposely never asked about anything which I knew would be inappropriate. But something happened within the Politburo.
So do you think that we've reversed the trend, the inexorable trend towards a market economy?
Oh, yes. First of all, we're seeing some of the effect already, but I think that what is going to start to happen is that there's going to be more controls, more of Mao Zedong, shall we say. But in other words, Xi is going to endeavor, as best I can see it, to expand his power base. And where it goes from there, I'm too far away, both intellectually and geographically, to get any real good insight.
No, I think that also is not well known inside or outside, but a couple of things that are happening in China are so interesting. Our own team, Yan Wang, had done a study of unemployment in China is going up. A lot of those figures are not necessarily in the Western press, but if you look at the local press, there are employment issues, which are big political issues.
No, they report there.
Some of them do, but sort of the local, there's local level unemployment numbers that are not yet fully crystallized into other numbers. But the other thing is we saw the change in leadership in some of the big tech companies in China, and people think that that could also be politically there could be a political impact on that. But going back to what you were saying, Liaquat, in terms of the US versus China and China having so much impact on the rest of the world, is that something that you think, is that just in emerging markets, or you think just Europe and coming back to impact the US as well?
Oh, I think, China, obviously, let's look at Apple, what happened with Apple.
Yes.
It has, what happens in China has repercussions, not only in emerging markets, but, in developed markets. I think the interesting question is, one, what are the consequences of this trade negotiation that's going on? And does that have the potential? I don't see it has the potential to revive growth in China. I just don't see how that's going to happen. So it can only be a negative for growth in China, and it's really so the expectation that this is going to sort of change the dynamic is I think misplaced.
You see more downside then?
Oh, yeah. Even if they do a deal, the deal will subtract growth from China and might marginally add growth here, but not much.
Insignificant.
Yeah.
Alan, what is your thought about what's going on the tariff negotiations between US and China? Where do you think we'll end up?
First of all, let's remember what a trade war is. The winner of a trade war loses, because what a trade war is taxing your own people. A tariff is an excise tax. it was originally a means, the primary means in the United States of raising revenue. There was no income tax. Eventually we started selling land after the Louisiana Purchase. But in the period through most of American history, tariffs were a major source of revenue. And what is happening is basically we forget that where that revenue is coming from is essentially an excise tax. Now, if you're going to tell me that somebody's economy expands and beats the competition by taxing itself, I have to go into a different profession. And it's very obvious that what is happening is that both China and the United States are being impacted by, one, the actual tariffs, but two, more importantly, the expectations of what everybody's talking about. And I don't think, I cannot believe that President Xi doesn't fully understand it. I can fully also suspect that his opponent in the debate doesn't understand it at all. But the point here is that the winner of a tariff war is basically the one who loses the least. But they're both losing, and that's scarcely the type of battle which the rest of the world ought to be as concerned about as apparently it is.
The interesting thing is that the rest of the world also was very worried about China IP issues and China generally in trade. So it was not just the US versus China. I think it sort of maybe politically became that. But it seems like emerging markets, Europeans, Asians, and the US have a common interest in getting China to be more open in terms of its markets. But this trade negotiation and the tariff discussions, as you both said, do not seem to be really addressing that or the bigger IP issues that are the elephant in the room.
Yeah, and I think the bigger IP issues, put it this way, I think going forward, once the trade is out of the way, and I don't think will end up being a big deal, because I don't think President Trump is keen on launching a major trade war. So he's always backed away from. He talks tough, but he always eventually does a deal. The IP issues are much more deep-seated and much more problematic, because I don't think, I think the perception that China does not play by the rules of the rest of the world is now very much ingrained, and it's an issue both in the US and Europe. And I don't think China intends to play by the rules. So I think this is going to become, the dynamic between China and the rest of the world, I think, has fundamentally changed from the last 20 years. And it may have to do with what Alan was talking about, which is a change in sort of political power within China. It's a change in perception of the role that China plays in the world, which is going to influence us for the next 20 years.
Yeah, you know, I mean, China, per capita GDP in China is 1/3 what it is in the US. I mean, that gap is huge. And what I find peculiarly ununderstandable in our position with respect to tariffs is we're trying to resurrect in the United States the steel industry, the aluminum industry, and all the industries that thrived and were the dominant forces in the United States in 1960. And so what we're trying to do is to reverse the growth rate, which is 2, 3, 4% a year, and go all the way back to 1960, Now, that is scarcely, from my perspective, the appropriate.
We're not actually trying to do that. I mean,
no, but that's in fact what we're saying
we
implicitly.
say it,
Yeah.
but we're not going to do it.
Well,
right?
well, of course not. But remember that the president's basic view is the Rust Belt.
Right.
The Rust Belt is rusting away because it is obsolete. And no country endeavoring to become the dominant force, economic force in the world can function on that basis.
Yeah, it's at the time when China is saying they're spending so much money on AI and so much money on technology and so much money connecting points A to B. I think the numbers I saw recently were like, many thousands of kilometers of new railway. At the same time as yesterday, we just scrapped our one potential rail project in California. So those could have a longer term impact.
Oh, I think they not could, but will.
So sort of going on that point, if China is trying to both verbally become more insistent on being the dominant economic power in the world, and the current rhetoric in the White House and the U.S., are we going to see proxy wars? Because we had the Korea issue, which you talked about Korea long before I think it became a topic in the newspapers. Are we going to have a lot of proxy wars outside the trade wars between China and the U.S. or now of course China, U.S., Russia, and is that going to have a impact, especially this year, on markets that is not being perceived? Because obviously we're seeing this big, upswing in the markets in the last few weeks.
I mean, I think the one statistic that really sank home the change was the collapse in Chinese investment in the U.S.
Right.
Which has fallen by, 70-80% in 1 year. So the globalization in the capital markets and China becoming integrated with Western economies on the capital side,
Right.
I think is coming to an end. Now, I don't quite see how, what happens and what they do with all that capital that is bottled up there. But if it doesn't have an outlet, China has very high savings. It's accumulated all these savings, and the natural thing would have been for them to invest it.
Well, they do invest it, however, historically, because their savings rate is 50%,
Right.
but so is their investment rate.
Right.
And the question is, you're quite correct in drawing attention to it. It's currently going on, but if you look at the Chinese history, and I have a chart somewhere along the line, which has got the United States and China, savings rate, China, savings rate way up, investment rate very close to it at 50%. Down here, the United States, 25%. Since it's very obvious that productivity and therefore economic growth is a function of capital investment, China, as it stands now, if they can hold anywhere near the 50%, and I don't think they will, I think they'll begin to ease off a bit, but still they're finding means to use their savings.
But I do think the return on their investment, if that investment just stays bottled up in China, the return on that 50% investment rate is really falling. I mean, they've built way too many, empty apartments, and they've got way too much excess capacity in infrastructure.
Innovation and
well, but
AI,
that's actually not capital intensive.
That's true.
I mean, that's knowledge intensive, and the hope was that they would take that 50% investment rate and they would spread it around the world. And to some degree they are, but I think the receptiveness of the rest of the world to their investments has declined
Especially
considerably.
in emerging markets.
Yeah, well, in
One Belt,
emerging
One Road.
markets and in the U.S. I mean, the idea that a Chinese company would acquire a major U.S. company is sort of totally implausible now.
And what has happened with One Belt, One Road is that some of the loans given to a lot of the emerging markets have kind of been for projects that did not end up very well. And now they're having difficulty paying back, but then China is also calling its debt and maybe getting new natural resources in those countries. So there is sort of a spiral going, which is not very good for a new, exactly. Coming back, one of the topics that Alan talks about, coming back to the US, has been stagflation. What we hear about all the time in the last month or two has been the US is going to experience a recession maybe at the end of 2019, 2020. What is your thoughts about recession or stagflation, and what, has anything changed in your thinking, really?
Well, if you take a look at the budget, the federal budgets, we're going to be running $1 trillion deficit this fiscal year, and it's going to get larger as time goes on if you use the ongoing structure that is now built into the system. Most fascinating thing about deficits is people complain about them, but they never do anything about them politically. And the reason is that when politicians are confronted with, would you like to spend or would you like to tax? They like to spend. Do they want a tax to cover it? I'm going home. And the problem that we're getting into now is something which we've had historically. It's only when inflation emerges as a consequence of the Federal Reserve ultimately monetizing the actual deficit, because what happens when the deficit doesn't get funded is the economy weakens, and so the automatic response of the Fed would be to expand. But the problem, obviously, is if you do that, inflation takes hold. What is fascinating is we've gone through long periods of very large deficits without the political response. The political response, however, that matters, that the electorate reacts to, is basically wage and price controls. President Nixon put wage and price controls on in 1971 when the inflation rate was 4%. Now 4% historically is not particularly large, but you can have huge deficits, which we're looking at now, and nobody talks about them. I mean, they never get discussed even within the structure of the congressional discussions, because everyone wants to have a little project in there. Funded? What's funded mean? Double entry bookkeeping has been eliminated from the lexicon of the political system.
Any signs of a slowdown? Alan, you track economic data very carefully. I don't see any signs of an impending recession.
There's no pending recession. I agree with that, and I think one of the reasons is that we have a situation in which the pressures are not yet strong enough to make a big contraction. But what we do have, and we see it in the last several weeks, is continuing claims for unemployment insurance have all of a sudden flattened. Well, in fact, if I could find the chart here, we can show everybody the chart. But yeah, here it is. It's the bottom part of the chart.
So that's actually quite a significant turnaround.
It's a very significant turnaround. And if you go back historically, it's not a bad indicator of the inverse.
Yeah, this turn up here since October.
That's suggesting that these are the most recent data. The employment figures, the payroll employment figures, come in after this, obviously. And this is as good an indicator as I have in estimating what the actual figure is likely to be, because it's the inverse of the employment numbers. And that suggests that we're going into a period which was 2.5% real growth rate, and I think we're slipping under 2%. But there's no really significant change in the longer-term outlook, largely because, if I can find another chart, I get charts of everything. But better I explain. What these charts show is that we don't have data on business capital appropriations. We have spending, but spending is approximately 6 months after the actual authorization by the directors of corporations to implement projects which show up as spending. And if you go back historically, it's fairly apparent that if you can get, what we have done is constructed a synthetic capital appropriations, so it is timed for the business sector back at the point when the decision is made, not when the expenditures are made. And that particular series, which leads the expenditures quite well, is still deleveraging. In other words, we haven't even gotten to the point of turning around. So I can see the slowdown occurring. We're seeing it here, and it'll probably continue. It's more consistent with 1.5% GDP, but it's not recession. You don't get recessions in periods of the economy being still deleveraging.
Right.
That you got to get beyond that, and we're not there yet.
So we could just go back to we could go back to a sort of period of 1.5% to 2% growth for the next couple of years.
We could.
But but the debt that is there, corporate debt, is huge. Student debt is what, 1.5 trillion? And I actually was curious to ask you a question about that. And of course, we read today in Axios, and New York Fed numbers, that we're like 7 million people are behind in terms of car loans. So if we're seeing those numbers, and students, if they have those loans, we've never had an economy where our students were burdened from age 18 to 22 getting into the labor market versus us getting loans or mortgages later in life. It's very different when you basically get so burdened when you come out of school that you cannot spend, you cannot save, you cannot buy a car, you cannot buy a house. How is that going to impact things, going back to what you just said?
So could we get a recession caused by excess debt?
It usually doesn't happen that way.
It usually doesn't. But 1990, didn't we have a...
I'm sorry, I was just about to say, you're talking about this. Somebody has yet to come up with a particular congressional initiative which forgives X% of the debt. Now, who is going to vote against that? The taxpayer? No.
Interesting. And you meant student debt?
Yeah, student debt. Because remember, a goodly part of it is, student debt was down here until the federal government came in, overtakes. And it's the reverse, forgiving the debt is the reverse of the double entry bookkeeping predisposition of the political system. It's not a pretty sight.
No, and also it's a very US-centric issue. So students in the US are left with this kind of debt. Students in Europe and in China don't have this kind of, or Japan do not have this debt. So we cannot say that there is no impact on the future.
No, I would agree with that.
Jumping into Europe, we haven't got into the Brexit yet, but I'm very curious. Both of you know the UK economy extremely well. And it was interesting yesterday, the governor of the Bank of England was talking about how a Brexit problem can impact not just the UK and Europe, but potentially global growth. But looking at it more narrowly, just at the UK and Europe, what do you think is going to be the outcome of what Mrs. May is doing?
Well, I think Brexit is, I've always been against it, first of all. I'm a, quote, Remain.
Right.
But what's wrong with Brexit, it's got two separate issues. The EU's economic issues, which are obviously very positive, they're extraordinarily helpful for Britain. And then they've got the immigration. And what struck me early on in the discussion with respect to before the vote, I said, I just read that there was a big scurry in Piccadilly Square because certain Bulgarians, groups of Bulgarians showed up, and I said, oh my God. If we were to put out there, took the Brexit vote and split it into two, I think they would find that the EU part of it, the economic logic, but there is a tendency to believe that you have to inexorably tie immigration, freedom of immigration essentially, with freedom of goods. That is an unfortunate mistake and doesn't recognize some of the prejudices that people are prone towards. You can't get heated about the issue of whether the tires in a new car or this or that, but you can get very heated if somebody is moving into your neighborhood. You won't talk about it, but that's the regrettable conclusion. That well, we human beings are not perfect. And my impression is, I don't know this for a fact, and there are people who do dispute what I'm saying. I think that if we were to split the vote into two separate yes-nos, I would say the vote would be very obvious. We would be remaining in the EU on the economic issues, but not on immigration.
You've lived in the UK for a long time.
Yeah,
What is
so
your sense?
Look, I think they've got themselves into a bind because they know what they don't want. That's why they voted for Brexit. Now they can't agree on what they want.
Well, see, that's not inconsistent with what...
No, absolutely. I think it's driven largely by non-economic issues, and principally immigration was a central problem. What does that lead to? I think it probably leads to a no-deal Brexit. Which the one thing I've always been impressed by the UK, though, is it has this fantastic safety valve, which is every time it looks as if it's going to, the economy is going to really tumble, the exchange rate goes down substantially. Mm-hmm. And so what I think, and we saw some of that, June in 2016, when we got the vote, sterling went down to 122. Lo and behold, we did not get a recession. We actually got the economy holding up pretty well because they made themselves cheaper. So I think the single best trade at the moment is to short sterling. It's at 129. I think we'll definitely go down to the low 120s, and I think we'll probably go even further.
You know, there are a lot of people right now looking to invest in companies in the UK. So I think
that's
that would
exactly
be
right.
very
You know,
interesting. Yeah.
They just, it's a couple of countries in the world just have figured out that if you just let your exchange rate go, Australia has done it and has avoided a recession for decades by allowing its exchange rate to be flexible.
Well, that's the purpose of exchange rates.
Exactly.
I mean,
and if you're a small country, you can do it.
Well, you know, when you were on the gold standard, it was a very difficult issue to deal
Right.
with. But if you believe in flexible exchange rates, why don't you act that way?
Right.
So Europe.
Well, as you know, I have been very much concerned about the issue of what we measure in the Target 2 clearing system of the European central banks, which obviously at the close of business every day there's debits and credits. Well, right at the moment we have something over 900 billion euro credits to the Bundesbank. And you might expect, well, certainly Italy and Spain would be negative, and they are. But what you wouldn't expect is that the European Central Bank is a major debtor in the total system, and it's getting ever larger. Aside from the Bundesbank, only Luxembourg has got a significant positive credits to the system. And that, of course, is a steel mill and a bunch of German banks. So the system is very, very unstable. The thing that worries me most is the European Central Bank is borrowing from Target 2, and the numbers keep going down. That is an unsustainable situation. At some point, we are going to get a new governing regime in Germany, which is saying, here is all of this wealth that we are not accumulating. Let's go back to the Deutsche Mark. Because remember, the reason they're on the euro is it's a much weaker currency than the Deutsche Mark was. And I suspect that if you ever got that, the turmoil which could emerge as a consequence is very difficult to figure out. I don't know when or how it's going to happen, but it is an utter imbalance in the system. It cannot persist indefinitely. How it evolves, I do not know.
One last word on emerging markets. That has been seeing the largest flows this year. What is your thinking? Is it going to outperform or underperform developed markets?
I think it's going to outperform just because it's underperformed for so long. And that emerging markets are cheap. I mean, I don't,
But
you know.
it's not in the definition of an emerging market.
Well, typically the emerging markets are riskier and should actually give you a higher return. But we've had these giant cycles of 5-10-year periods.
Yeah, no, you make a good point.
Where emerging markets have done very well, and then 5-10-year periods where they've done very badly.
That would have nothing to do with the broad economic.
Yeah,
that's
and I think we've come through a 5-10-year period where emerging markets have substantially underperformed developed markets. And at the problem with being a value investor and saying something is cheap is it's not great on timing.
Right.
It's not in the economic growth rates, which are higher,
Right.
but in the for valuation, they are lower.
Exactly. That it's it's unusual. So I don't know. Probability that emerging markets over the next 5 years do better than developed markets, I think, is
Possible.
high.
We can't not ask you, we have also this great quote behind your book from Liaquat, a sweeping and brilliantly told narrative by two authors who have spent their careers thinking about the wellsprings of economic growth. You talk about innovation, you talk about entrepreneurship in this book. What do you think, and you look at the history of American capitalism, what does it teach us about where we are today, Alan?
Well, remember, what the whole focus of the book is the fact that it's capitalism versus the other forms of economic organization, which of course would be socialism, communism, and if you get a figuring it out what it is, populism. This endeavors to take the issue where capitalism has always been the central theme, even at the points when considerable amount of socialists showed up for minority parties. And the book tries to examine why capitalism is such a potent force in economic growth and standards of living. And we take each period of history and go through in some detail as to what happened and why creative destruction, which is a crucial aspect of how a capitalist system works, how in very specific detail did it engender a very significant growth rate. We are now and have been basically almost since colonial times, been the largest economy in the world. And we are still there, and we go through ups and downs, stagflation, all sorts of things, including the current period. But somewhere along the lines, we pick up. As we make a point in the book, it's not an accident that after going through the 1970s and the stagflation and the like, and the issue of our whole industry becoming elderly, up shoots artificial intelligence. Who's in the forefront? Major American companies, Apple, Google, etc. And so the point we're making, there's something in the culture of the United States which creates this particular phenomenon. And remember, what creative destruction is essentially the process by which advances are made. When the Pony Express gave way to the telegraph, a whole industry disappeared. People, horses, needless to say, and so that what you get is all of the major changes that occur in technology are partially destructive. In other words, it's almost as though you have to make way for the room of the new insights coming on. And it's never been planned that way. It's the way it happened. And for example, the one proxy is unit cost. Unit cost is the inverse of productivity, and productivity is the issue which determines how prosperous an economy is going to be. And our productivity growth rate has been extraordinary over time. So we started from this little place down in Virginia and Plymouth in the 17th century, and we rapidly overcame Great Britain, which was our basically paternal country, and then we went into the Revolutionary War, and the whole process with the very odd inconsistencies which was slavery, and the huge impact that had on the Civil War, and how the developments during and after are really what galvanized the economy, so that during World War II we essentially stood alone as the major force which were able to fight both the Japanese and the Germans, two, as it turns out, very competent cultures, because as we find out now, they're our best friends. But it's that whole pattern of how did it happen, why did it happen, and who were the essential players in it.
Thank you so much, Alan, and thank you so much, Liaquat.
By the way, can I just endorse this book? I blurbed
Absolutely.
it is a great book. You will learn a lot, and it's a wonderful sweeping history of the United States, economic history of the United States.
It's almost as good as your book.
Right.
Thank you very much, and look forward to our next call.
Wonderful. Thank you.